Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player.
Good day, all. Ira Epstein of Linden Associates with your agriculture update for this Thursday, the 25th of January, 2018, and we're getting on right now to 2:20 p.m. Central Standard Time. Unchanged soybeans, corn down 1 1/4, but the corn did try the upside. It was a failure on the market. The question is, was that it? It got very close to the 100-day average, didn't go anywhere. Wheat's still holding up. The sugar market held up, and we got pretty violent conditions going on in the metal markets and the others, but I'll cover those in my metals update and the financial review. Suffice to say, President Trump did what I expected. He made some wording, and boy, set the markets on fire as he tried to clean up what Steve Mnuchin said yesterday about a weak dollar. Let's take a look at soybeans. And by the way, there's a lot of action in the meat markets you're going to want to see here because they really fell apart at the end of the day. In the weekly area chart of closes, we're still in this up thrust that we've had in beans from a 947 low getting up to 992 1/4 on a closing basis. Pretty much unchanged today on the day. You can see that right here. And you've gone on a daily chart closing basis up 42 cents roughly. Very strong action. When we take a look at how you've gone, you can see how the market has just picked up and run. The question is this going to prove to be, this whole area right here, a big resistance area for the market? In terms of the swing line, which determines and helps you to visually see, is the market trending? And I'll define an uptrend as higher lows and higher highs, which you have right here. There's a low, a higher low, and certainly the higher highs. That's the beauty of when you put this on with the swing line. You don't see it this way. If you do, wonderful. I created it. It's very hard. I can see it that way. I'd say 90% of the people can't. And there it shows up very easily. So what I can tell you is that if you take out 979.5, you break the idea that the market is trending. Until that occurs, it is. Where are potential resistance zones? Well, one of them is the 100-day average. And for the past 1, 2, 3, 4 sessions, you have hit that number. So it's obviously a number that the market's caring about. The other number is the upper Bollinger Band, which you today ended up closing back under. Now, it's not as important here as it was in the meal, but what is happening is I want you to look at how the red and the blue lines that make up the momentum oscillator, called a slow stochastic, is acting. Today, both numbers are over 80. Yesterday, both numbers were over 80 on a close, not the day before. It takes 3 consecutive sessions in a row under my rules to convert the market from being overbought, which I call it right now, to saying it locks in or embeds in a trend. When it loses that embedding, it's often when the red line, when it's a downtrend, gets back over 20 or an uptrend gets back under 80. Got that? And that often leads to a further price break. The key words here are often. Nothing is all the time. But you're playing, when you're looking at charts, for percentage plays. I cannot tell you that 100% of the time something happens because I've not seen it. I've seen often, I've seen real often, but I've not seen 100% of the time. I'm looking at the meal. Now, you had, going into today, 6 days in a row over the upper Bollinger Band. I've given you a definition. 5 is what you typically fall back on if you get to 5. 7 is really stretched out. It can happen, but it's really stretched out. So what did you do today? You had your pullback. You're out of that dilemma. Now, you've had a straight up run. Where do you get in and where would you put a stop becomes the big problem in this market. If you put a stop under a most recent low, which is the most logical area often on a chart, that won't work. That's $3,000 away. The fact that the market did stay 3 days in a row, or rather 6 days in a row, closing over the upper Bollinger Band, should be taken as a sign of strength. Now we'll look to see, does the market back off at all? The soybean oil has been the draggard. When you look at a crush bed and you take the soybean and you crush it for animal feed or other ingredients you're doing, you're going to get the soy oil and that's used cooking and God knows, many, many things, including biodiesels and all that. Well, as you look, you've got the lower highs, the lower lows, the market oversold. I don't see anything I'd want to do with that. In the corn, we had talked yesterday, let's go to yesterday, that this was the first challenge of the 100-day average. If the market could continue up, and it was overbought, is overbought, 358 at that point would be the next resistance zone. That number went up today to down to 357 3/4. You hit a high of 358 right on the button, and you backed off from there. So the question is, what do we have? And I wish I could answer it. I can't. I have an overbought market with a lower low and a higher high that tried to push out the upper Bollinger Band, and for one day at least it failed as the market pulled back within it. In the wheat market, the short-term trend is turned up within narrow Bollinger Bands. That's why I say the short term. Higher lows, higher highs, the resistance, the upper Bollinger Band at 439 3/4 and overbought. Remember, when you're over an 18-day average of close, be it in corn or wheat, one of the things I teach in my charting course is the market has upside bias. So until it's under that, the bias stays up. In the sugar market, I pointed out yesterday, and let's go to this, that today was going to be a fairly important day. Why? Because I looked at the low here, and I'm looking at this low, and if you had an update today, you're actually going to end up with higher lows. Because the legacy started way back up there, actually, with lower highs, lower lows, that is still in play with the embedded reading. I think that what's happening right here is the market's trying to move sideways, and the question is, does it make a run for the lower Bollinger Band? And I mention that because until you lose the embedded reading, the strong bias is to the downside. You've had a crossover that's bearish where the 18-day average is over the 100. Still a bear-looking chart. If you knew nothing else and you're at the coffee market, you're oversold. You're in a market that's trying to put on a pattern of lower highs, higher lows. I've got this pointing up because I already knew the action this morning. If you take out that high, maybe you make a run to the 18-day average, and that should be the resistance. That's where you're at. You have a market that is still closing under the 18-day average, so I'll call the bias down. The momentum pointing up, and the short-term swing line trend is pointing to the upside. I call it a confused chart. In the cocoa market, you tried yesterday to break out to the downside. You failed. If you fail, maybe the resistance of the upper Bollinger Band comes into play, and that's just what happened today, whipping those traders. As I said, this market's really looking for direction that it doesn't have just yet. In the cotton market, could this be the beginning of a break? Very frankly, if you take out 81.61 or today's low of 81.76 even, you could end up with the pattern of lower highs and lower lows. The problem for the market is that you're still over the 18-day average of closes. So the pullback can go there, but it's very hard to get a position that you're going to say is bearish unless you close under that 80.63. The bias is up, momentum flat to pointing down, and the market's looking for a swing line direction. In the cattle market, this whole rally that began here ended up culminating today at 126.30, 7 ticks shy of the upper Bollinger Band. Could be that some trader stepped in right there and said, in front of tomorrow's Cattle on Feed report, they're going neutral. If you take a look, you fell right back to the combination of the 100-day average and the 18-day average of closes. You're just above both numbers, but you're falling to them, and momentum is starting to turn down on you. Have you been trending during this whole rally? Not really. You've had a lower low and a higher high. In the feeder cattle, you have to go back here now, and I didn't even do that when I did this. This high is 147.87. You break down, you come up to 147.50, and today you get to 147, yesterday 147.72. So I didn't catch this before I did it, but this line should be pointing down with the red line. You have lower highs, lower lows, you're under the 18-day average, momentum is turned down. Going into the Cattle on Feed report, this chart is throwing out fresh new what? That it's a bear market. Fresh new signal on that. Pros might be hitting this market 144.50 area. It's a lot of risk back up through a cattle report and also 147.75. But on a pure chart basis, knowing nothing else, that market's turned down. I don't understand why the hogs even went up yesterday to break a nice trend that they had. They tried today and they did go higher, and then they fell apart down to 73.75. As I tell traders so often, I am convinced ETF traders have taken over. It's my own opinion. I said ETF. It's high-frequency trade, boys, have taken over the dominance in these meat markets. I believe it. I watch it trade, and I just see that so often. I'm convinced that you got to hit and run in those markets. I don't know how long they actually trend one way or the other, and they seem to go opposite. You buy when you should sell. You sell when you should buy. It's just a whole different world with it. But if you like to play seasonals, well, there's a service that I think you should give a try. It's called the Moore Research Center. And what they do is they break down seasonals on a daily basis. In other words, you'll get seasonal trades. You buy on this day, you get out on that day. Here's the percentage of winning times out of a 15-year period. If it loses 3 times in a row, they drop it completely. They give you how much an average day gain or loss has been. You start playing with that to get an idea of what a seasonal is. Does this stand on its own? Absolutely not. Want to go on record. They say it. I say it. I've used them for many years. No, it's one of a tool. It's no different to me than a moving average, a Bollinger Band, a stochastic. But it's nice to know what the seasonals are because there are influences, and then to help you with those influences, they put out reports about them. So now you're able to see it. They also do that in the seasonal spreads. You get a full explanation that's written up every month. You get an idea of what's going on through there. And yes, you get interactive charts. You can look back at bull years, bear years, what they look like. You get to see the reports right there. To get a 2-week trial, either give us a call. You can go to our website. You'll see a carousel of free offers. Click that, sign up for it. Click up here, you can sign up, or underneath us it says, click here for Ira's free offers, and we'll take it from there. I'm Ira Epstein. You have a great day, and I'll see you tomorrow.